Welcome back to the Clara CFO Group channel. Today we're going to do another financial review. So this is where I'm actually going to take real life financials and walk through them and point out things that I think are interesting from a small business CFO perspective. And if you haven't seen these videos yet, I do actually have a playlist of them, so I will make sure that that is available. I will put it up here somewhere so you can click on that. If you watch this video and you're like, hey, I want to watch the other financial reviews that we've done, you can go to that playlist and we put them all there together. We've done a salon, a bakery, and a couple other small businesses as well. So today we're going to talk about a construction company. So I'm really excited about this because I know there are a lot of construction businesses that watch this channel. And I also know that there's other things that we can always learn from any business, even if you're not in the exact same industry. So I'm really excited to dive into this. I haven't actually even looked at them yet. They're all there, and because I want to actually record these things when it's really fresh and it's kind of, I'm looking at it for the first time. So I think this should be really good. So we'll go ahead and get into the financial review, and I'm just going to talk through what I'm observing and try to give some advice along the way. All right, let's get into it.
All right, so here we are in a construction company. I like to keep these business names very simple, and this will help us as we go through these financials today. So this is really all I've done so far was to just go through and make everything pretty generic. But I really haven't taken time to analyze these financials yet because I really wanted to take a really fresh look with new eyes on these financials and give you guys just really what I see in a really quick snapshot because it's really interesting to see the story that financials will tell. So let's go ahead and let's look at a construction company today. So we're going to start with the profit and loss. And what we have here is we have the January through June of this year financials. And these are real financials that a real business owner sent to me, but we've just made them taken out anything that could be identifiable. And basically just trying to make this as generic as possible, but these are real financials. Okay, so this is and I do know this about the company. They're a residential construction company, and it's basically one owner who does the majority of the work and subcontracts out jobs here and there. He doesn't have any employees. His wife does the administrative side of things, and then he does all of the work. So this is a large amount of our construction population. A lot of times it's one person kind of starting their own business and doing their own thing. So hopefully this will resonate with a lot of you. So one of the first things I noticed is that the construction income is pretty up and down. And this is probably something that I would have expected based on, billing procedures and the way that this individual ends up billing his clients and how he takes payment. So I am seeing like January and February were pretty slow, but then March and April, March had a really big payout. And this could have been maybe like the timing of when clients actually paid, or maybe this was just a really big month. I'm not sure. And then April and May, it kind of died down a little bit. And then June, it got really quiet. So total year to date is just over $100,000. And when we look at the 2021 P&L, we actually see a really kind of a similar trend. We're seeing March was another big month, and it kind of died down a little bit in May and June. And then total year to date last year was just over 200,000. So it seems like they're pretty much on par with where they were last year. If we just do a quick like sum, yeah, so that was just about $100,000. So pretty much on par. So it doesn't seem like there's a lot of growth happening right now. It's pretty much kind of status quo with where they were last year, which is okay. Just kind of a fact to start off with. One thing that I wanted to see just right off the bat as I was thinking about, how many hours do you think this is representing? So if I take 6 months, and let's just say it's a 40-hour work week, and then let's do it this way. Let's do 52 weeks divided by 2 since it's a half year. And then let's say that many weeks times 40 hours is about 140 hours or 1,040 hours. Let's go ahead and just see what that looks like if we earned that over that amount of time. So that's billing out, if you work 40 hours a week with no vacations, about $96 per hour. So if we were to maybe change this to maybe a 35-hour work week, for example, that would look like $110 an hour. So I just kind of want to get a feel for maybe the volume of how many hours are being put in right now, because I'm not exactly sure. But that would be a question I'd have to this business owner is, what is their capacity to work every single week? And that would be one of the questions so that we could kind of figure out what does really the price per hour need to be. So when we move down from here, we've got cost of goods sold, and I like the way that they've got cost of goods sold added in here. So they have construction material costs. So this is probably direct costs for projects, and then they have equipment rentals for projects that they wouldn't need to do unless they had a project. So I love seeing those two things in cost of goods sold, and then they have subcontractor expense. The way that they have this broken out, they actually had this by the name of each individual subcontractor that they like to use, which, in this situation, they might like to see that really clearly, like how much did we pay so and so every single month? And that can be helpful. So if you like that, I typically don't break it out like that, but I could see for a smaller construction company, it might be really nice to have it broken out like this. And I really have no problem with that. If you want to customize your chart of accounts to have it that way, that is totally fine with me. I do like to see subcontractor direct expenses up here. And then they have other like small tools and things that they've needed to buy and supplies specifically for projects. So overall, I'd give them a solid A in how they've broken out their cost of goods sold. I really like seeing all of these expenses up here in cost of goods sold. Really, really good. So what that gives us is it gives us gross profit. So this is how much, everything we've taken in the month minus everything we spent. This gives us gross profit. So what this tells me, and I'm going to do a quick percentage here. So after they've paid out everything for direct labor and materials, they are taking home 44%, or he is taking home 44%. Honestly, I'd like to see this flipped. I'd like to be 40% in the costs, and I would like to see 60% coming home to pay for everything else. So, what this is kind of indicating to me is I'm not totally sure that the pricing is okay. And we're going to keep going, but this is an indicator. I would like to see gross profit be higher. Okay. So that's just kind of an indicator of, maybe we've got something not working all that great in the business model. When we go down to other expenses, and they did inform me too that they don't have a physical warehouse anywhere else. This is mostly operated out of their home, and then a van that they own, and obviously using like the garage and whatnot for storage materials. So in this situation, we don't have big facilities costs. So like right now, we're not even paying for a storage building, for example. So looks like the first expense we have here is advertising and promotion. Really, if all they're spending is $10 a month on advertising, that is quite impressive. I do think that they probably get a lot of their business from referrals. My question is, could they maybe invest a little bit more money into marketing and maybe be able to either get higher quality or maybe like higher paying jobs? Or could they maybe do something that would maybe potentially allow them to get into slightly more lucrative projects? So I'd be curious here what they're doing and then really how projects are coming in to see, if there's opportunity to maybe get into a slightly different market and maybe expand into a different area or something like that that might allow them to charge a little bit more for their services. Here we have vehicle expenses. So the van, I mean, anybody who has a construction van, I mean, I think that it's very, very common to need to have maintenance. They drive it a lot. They use it really hard. They have to, change tires. They need, to make sure that that van is working because that becomes their livelihood in a lot of ways. So, seeing expenses there makes a lot of sense. I'm not exactly sure what this little trailer expense is, but it's pretty small, so I don't really have any concerns about that. And on expenses, like none of this is concerning right now, except for maybe like, should they be spending more on marketing? When it gets into fuel, that makes sense. Again, you got to drive around to the jobs, totally fine. Dues and subscriptions, I wonder if this is some type of chamber of commerce or some type of construction organization. And then I'm really happy to see that they have some really solid insurance on the books. Happy to see, auto, umbrella, workers' comp, and then a commercial policy. So all of that is really good. If you're doing construction, you definitely need to have good insurance. And then we get into just basic office supplies, some professional fees, probably some accounting, I would imagine, maybe a tax return, something like that, and then a uniform expense. So really, I mean, all in all, the other expenses outside of the subcontractor and direct costs are very, very low. So good job to them for really keeping all of the superfluous stuff out of really just not significant at all. I am kind of surprised to see there's not really any software expenses. So that means to me there's probably not a whole lot of digital services that are needed. And then not having an actual facility that also saves a lot of money. So it seems like they're being pretty efficient with all of their overhead. Um, and this might also be just a deliberate choice as well to be like, hey, we want to stay small enough so that we don't have to add a warehouse, so we don't have to add a bunch of other vans, and we don't have to expand. So that I do believe that is by deliberate choice. And so this is a good example of what it could look like if you just want to stay lean and mean in your financials. So what we're seeing at this point is that the net income is about 35% of the total. And one of the biggest expenses you don't see right now is that you don't see the owners getting paid anywhere. And so this owner is having to basically take money out of profit. And so this will look like an owner's draw. And my concern is that this might not be enough for this business owner. And especially, we got to still pay taxes. So if I take 20% out for taxes, and then I say, okay, 35 minus 7, even if you take everything home and you're not going to be saving anything in the business, if I'm dividing that by 6 months, that gives me just under $5,000 a month coming from the business to be able to support home. I'm not loving that number. I did do a video one time that I really would like to see business owners taking home at least $100,000 every year, because it will allow for more flexibility. I mean, maybe this is enough for this business owner, but my assumption is that this is probably feeling pretty lean. So especially with rising inflation and whatnot, like I think this could be maybe not sustainable overall. I did want to pop into 2021 and see what profitability looked like. They did get a PPP loan forgiven last year, so if we don't look at that, looks like about the same. This is looking like about the same percentage, pretty darn close. So they had 39% profitability last year. And then probably if we do the same calculation, times 0.2, take this minus taxes, and then let's take that, divide them by 12. Yep, we're pretty much right around that 5,000. They did a little bit better, 5,200 last year per month, and that's a monthly thing. And so, and that, if they took home every single cent that wasn't going towards taxes, then that wouldn't really allow any additional to go into any savings. So I do have some concerns. So my main recommendation here would be to look back at pricing and to see and it could just be volume of projects. So it could just be, hey, we didn't have as many projects, we weren't working very much, maybe we were sick and we weren't able to work or something like that. If that's the case, that's understandable. But if you are able to work full time, my assumption would be that you should be able to produce higher income if you are properly priced. So I think this comes down to capacity. I think that's my biggest question. Like, what is the capacity for these projects? And then can you decouple decouple price and hours? So what I mean by that is, can you price projects based on the value to the customer? What's the price of their bathroom being retiled, or what's the value of their bathroom being retiled versus this bathroom retiling project is going to take me, 24 hours, and 24 hours times my hourly rate equals X. Let's say you had a 125 hourly rate times 24 hours, you'd say, okay, the project's $3,000. But what if this person is like really, really adamant that they want to get this done, next weekend, and can you please do it? And it would be so amazing if we could just, knock this project out. Well, in that situation, it might make more sense for their project to be priced at $5,000 because it's worth it to them to have it done faster and have it done, by this trusted individual than just the price per hour. So, I would highly encourage something like value pricing for construction projects rather than thinking about it just, rate times hour. Um, and then if you do decide to go with rate times hour, or yeah, rate times hours, then make sure that you build in flexibility to your contracts if you need to, like if you actually go over on your hours, because that can really, bite you in the butt if you promise a certain amount and then you go over on hours or the project gets much more complicated. Make sure that in your contracts you always have a way to bill additional. Um, the other thing I would want to say is like, I'm seeing that a lot of hours, a lot of money is being spent on certain subcontractors. So $15,000 to this one subcontractor, should you have an employee? Would it make sense to have an employee, and would this become more efficient and at a better price? Because the subcontractor could be charging you $85 an hour, but could you hire that same individual or an individual like that to do that same project for $30 an hour? I'm not exactly sure, but that's a question that I would ask. That concept really came up because I looked at the 2021 P&L and I saw that there was a subcontractor here that had actually been paid almost 25% or over 25%. 27% of the total income went to one subcontractor. And that to me is a good indicator that, either you're relying too heavily on this one subcontractor and, you're kind of getting out of your sweet spot of the work that you're trying to do. Or it makes sense to maybe hire in somebody into your own organization who could take over that type of labor. So I think that's one of my questions here. And, maybe there is like, maybe it makes sense to try to take on more projects where there's less reliance on subcontractors, and then you can keep more of the gross profit for yourself. And then, eventually what's going to happen is because you don't have a lot of overhead and general and administrative costs, you're going to have more profit at the end of the day. So it could just be the type of projects that are coming your way. I wonder if like maybe it makes sense to be a little choosier in which projects you take. If you think you're going to have to subcontract tons of it, maybe opting out of that and focusing more on just the things that you can do 100% internally with maybe one or two helpers, and then just streamline your operations. And I'm a big fan of niching down. I like personally, I don't really love hiring contractors that do it all. I like to make sure that there's like, specialization, because if somebody is, let's say tiling all day, they're going to become an expert tiler. But if they're tiling one day and then they're plumbing the next day and then they're drywalling the next day and then, they're doing other things the next day, they might not be an expert in any one area. So, I would kind of think about the overall brand. What do you want to be known for is the question. And if you become known as, the best tile guy in all the city, like then you can also charge higher prices. So that is kind of a nice thing about niching down. So I think like if we could, let's just say if we could bump up the construction income, by 20 to 25%, and then bump down some of the subcontractor costs by, 10, 20% there, you would start to see real shifts in the gross profit margin, which will, fall to the bottom line as well. Which could get up that you could raise up that monthly intake and also start to build up some savings, which I think we will get to in just a second. When we get into the balance sheet, I will make this a little bit bigger. When we get to the balance sheet, I was really happy to see a checking and savings account. I think it's great to have both, but I was not super happy with the balances. I can see that most of the income or most of everything we have here is in the checking. Really not much savings to be had here. So I would like to change that. I would like to see 2 to 3 months of operating costs in a savings account if possible. So that's why we've got to drive up profit in order to have some savings in the business. And, I know that times have been lean and things like that, but, if the business model is working and if you can get the right type of projects in, more profit can be created, and then you can create a little bit of extra cash in here. Couple other things. So they have fixed assets here. So there's basically just the vehicle and then some machinery and equipment. Um, it looks like maybe this is just kind of a bookkeeping error. Accumulated depreciation should never be more than the total amount of the fixed assets. So it looks like maybe some assets were removed off of the balance sheet at some point in time, maybe some old vans or things like that, and then the accumulated depreciation that was associated with those things did not get removed. So I would maybe ask your CPA about like getting a journal entry to fix this up, because if these are all fully depreciated, then you would basically just make accumulated depreciation the same amount as your total of all your other assets, because I'm not sure if these are fully depreciated or not. Um, but yeah, this is a little bit of an accounting error, I would say. So another thing I thought was kind of interesting was that there's really not a credit card balance. And I think actually this is a missed opportunity. I think I like the idea of leveraging a credit card in a construction business because you have some float between. So if you start a project and maybe you take a deposit, but you also need to buy the materials, and that you don't necessarily want to have to pay that out in cash. I highly recommend putting it on a credit card. You have the cash to pay for it, but putting it on a credit card will help float when you actually need to pay out the cash for that. And then you have more time to actually get fully paid in full before that credit card bill comes due. And sometimes people are just really against credit cards, so I understand if that's like just a deliberate choice not to leverage it. But you're missing out potentially on some good cash flow management by not using a credit card, and you're also missing out on potential credit card points as well. But I think the bigger thing, more than the points, is really just being able to delay cash flow by being able to put any big purchases on a credit card. Now, payroll liabilities, it looks like we've just got some, payroll in general. It's broken out like this. I have really no problems with that. I did notice that there's really no long-term liabilities here, real estate tax payable, but really overall, no long-term liabilities. So good job there, not having to rely on long-term debt to operate your business. Now, I am going to get into probably one of the most interesting equity sections I have ever seen in my entire life. Um, so the equity on this is broken out very interestingly. So they have basically taken every draw that they took out of the business, they've put it into a separate account on what they used it for. Normally, we would just see a owner's draw line, and it's just one line, and it's anything that the owner takes from the business is put into that line. But they have broken it out to show us basically their home budget. So it looks like they've used it to pay medical bills or medical insurance, home improvements. It looks like they have some rental properties, and the money has been taken out to use in these different areas. It looks like they've paid off lines of credit, maybe a mortgage, retail credit cards. Like, it's pretty much everything, groceries even. I have honestly never ever seen this. And they have just their regular, just kind of cash draws, I guess. So all of this is summing up to about, this is lifetime in the business, about 1.28 million. And that's what's been drawn out of the business. And so I would probably recommend not breaking this out. I'm not entirely sure what the reasoning for this is. I would basically just recommend collapsing all of this into one, members draw line item, because your personal budget is your personal budget. And, if you give somebody your financials, you might not necessarily want them to know, everything you've spent on clothing or groceries or something in the past. Even if all of your money is, coming from your business to your home, you can keep those two things separately. And I think that's totally fine. So this is what I would typically see, something a little bit more like this on our balance sheet. But that was kind of an interesting way to do it that I've never seen before. So, we're learning here on YouTube. I would not recommend that. So if you're currently doing that, sometimes I'll see people take draws and they'll say, draw, personal draw, and then draw for taxes, draw for, retirement. Maybe they might have a couple different breakouts. I think that's fine. I probably just wouldn't do more than like 3 or 4 breakouts of your different draws, because then where does it stop? So, I mean, there's a couple fixes I would make on the balance sheet. Like I mentioned, accumulated depreciation, and I would probably fix this members draw, choice here. But overall, it's not incorrect. Like I'm saying, it just is maybe a little bit messy, and maybe not needed is what I'm saying at the end of the day. Um, and actually, if this accumulated depreciation is fixed, it's also going to fix this total net, because total assets equals total liabilities plus equity. So there'll be a little adjustment probably to this equity line to balance out when this is fixed as well. So, overall, I think the balance sheet is okay. I think like I would really like to see more savings on for this business, because I'd like them to have a safety net in the business. If they, let's say he couldn't work for 2 months, who like what savings are there? And hopefully the business would have some savings to still be able to pay, the family normally, and that would be a good thing to have. So we're not going to review the 2021 P&L or balance sheet, but I use them just to kind of reference to see if these were anomalies or see if this is pretty normal. But overall, it looks like the 2022 P&L is pretty normal for the operations of this business. Like again, top recommendations would be to really look at pricing and total capacity and start to figure out some goals around what we'd like to see from a volume perspective on how much work can be done. And then I think I also would like to know what's really a good goal for take-home pay. Because if $4,700 is enough, that's great. We still would like to generate more cash so we can build up some savings. But I'd really like to know what is enough for this couple, and what do they need from the business, and what does the business need to produce. And then we can kind of back into what do the revenue goals need to be. And then when we know revenue goals, then we can start to set like, okay, we know we need to quote a certain number of projects, and maybe we need to increase the amount we're quoting per project in order to reach those goals. But again, I really would like them to really look at the projects that they're taking, see if they can do some value pricing instead of pricing per hour, or if they really just need to stick with hourly pricing, then maybe increasing the hourly rates. That might be kind of some good first steps. So, okay, well that's my hot take on this construction company. I thank you guys for bearing with me when my voice is a little bit raspy from recovering from a cold, but I appreciate you guys watching this one, and please let me know if you have any comments or questions in the comment section below.
All right, well, I hope that was helpful for you guys. If this video was helpful, please make sure to give it a thumbs up and tell me that you enjoyed it, because I love to hear if this has been helpful. These videos don't get tons of views, but so far what I've heard is that the feedback is that you guys really do like them. So if you'd like me to do more videos like this, please make sure to leave some comments and give this video some love. Also, if you are on our email list, this is how you could have one of these financial reviews done for your own business. So if this is interesting and you'd like to submit your business to be reviewed on YouTube like this for free, make sure you're on the email list, because periodically we will send out a request for financials. And if you see that, you can submit, and we will pick from the people who submit who we want to review financials for. So you might be the next one of these. I'd love to have you. All right. Well, again, let me know if there's any questions in the comment section below, and I will talk to you guys later. All right. Bye.